There's a $3 trillion market quietly growing behind the scenes of Wall Street, and most everyday investors have no idea it even exists. It's not trending on TikTok, it's not hyped on CNBC every morning, and it's definitely not something your average Robinhood trader is talking about. Yet some of the smartest money in America, hedge funds, pension funds, and ultra-wealthy investors are pouring billions into it. This is the world of private credit investing, and once you understand how it works, you will start to see why it's becoming one of the most powerful wealth-building strategies in modern finance. So, what exactly is private credit? At its core, private credit is simply lending money, but not in the traditional way you're used to. Instead of going through big banks like JP Morgan or Bank of America, companies are borrowing directly from private investors or funds. Think of it like cutting out the middleman. A growing number of businesses, especially mid-sized companies, either can't qualify for traditional bank loans or don't want to deal with strict regulations and slow approval processes. That's where private credit funds step in, offering faster, more flexible financing in exchange for higher interest rates. And that's the key. Higher risk, but also significantly higher returns. Now, here's where it gets interesting. After the 2008 financial crisis, regulations on banks tightened dramatically. Institutions had to become more conservative with their lending practices to meet federal guidelines and protect against systemic risk. While that made the banking system safer, it also created a massive gap in the market. Businesses still needed capital, but banks were no longer willing to lend as aggressively as before. Private lenders saw an opportunity, and over the past decade, that opportunity has exploded into a multi-trillion-dollar industry. Today, private credit is one of the fastest growing asset classes in the United States, quietly reshaping how money flows through the economy. For investors, the appeal is obvious. Private credit often offers yields that are significantly higher than traditional bonds or savings accounts. While your high-yield savings account might give you around 4 to 5%, and government bonds sit in a similar range depending on interest rates, private credit deals can offer returns in the range of 8 to 12%, sometimes even higher. That kind of income is extremely attractive, especially in a market where inflation continues to eat away at purchasing power. And unlike stocks, which can swing wildly based on market sentiment, private credit investments are often structured to provide steady, predictable cash flow. But before this starts sounding like a hidden cheat code for building wealth, there's a reality check you need to understand. Private credit is not risk-free, and in many ways, it carries risks that are very different from what most retail investors are used to. When you invest in public stocks, you have liquidity. You can sell your shares any time the market is open. With private credit, your money is often locked up for years. There's no easy exit. If the borrower runs into trouble or defaults, recovering your investment can be complicated and time-consuming. And because these deals are private, there's far less transparency compared to publicly traded assets. You're often relying heavily on the expertise of the fund manager making the lending decisions. Another critical factor is access. For a long time, private credit was almost entirely reserved for institutional investors and high-net-worth individuals. You typically needed to be an accredited investor, meaning you meet certain income or net worth thresholds set by the SEC. This kept everyday Americans out of the game, while the wealthy continued to benefit from these higher yield opportunities. However, that is starting to change. New platforms and financial products are slowly opening the door for retail investors to gain exposure to private credit markets, sometimes through ETFs, interval funds, or alternative investment platforms. While it's still not as accessible as buying stocks in your 401k or brokerage account, the barrier to entry is definitely getting lower. What's also driving the growth of private credit right now is the current interest rate environment. As the Federal Reserve adjusts rates to manage inflation, borrowing costs across the economy shift. Traditional lenders become more cautious, and once again, private lenders step in to fill the gap. This creates a cycle where private credit becomes even more essential during times of economic uncertainty. In other words, the very conditions that make the stock market volatile can actually create more opportunities in private credit. At the same time, there's an ongoing debate among financial experts about whether this market is becoming too big, too fast. When you hear that something has reached a $3 trillion valuation, it naturally raises questions. Are underwriting standards slipping? Are investors chasing yield without fully understanding the risks? Some analysts warn that if the economy slows down significantly, we could see higher default rates in private credit portfolios. And because this market operates with less oversight than traditional banking, problems could take longer to surface and resolve. It's not necessarily a bubble, but it's definitely an area where caution matters. For everyday investors watching this, the big question becomes, should you care about private credit? The answer is yes, but not in a reckless, jump-all-in kind of way. Understanding this market gives you insight into how modern finance is evolving. It helps you see where institutional money is flowing and why. And if you're building a diversified portfolio, it might eventually become a small but strategic part of your overall investment plan, especially if you're looking for income-generating assets beyond stocks and bonds. But like anything in finance, it's about balance, research, and knowing your risk tolerance. At the end of the day, private credit represents a shift in power. It's a reminder that the biggest